You have several thousand people working for you right now in a market where there are very few deals. At what point do you expect this market to come back in terms of deal-making activity?
Thank you, and thanks for the opportunity to share views with you today. Our first priority at Citi right now is making sure that the communities we serve and the clients we serve and our teams at Citi are safe. I think deal activity is focused on short-term liquidity needs. So we're providing companies that we lend to revolving credit facilities. We're providing new sources of liquidity for them in the form of new loans. That kind of deal making is happening right now. I think we take some confidence in what's going on in the investment grade debt market. We're in an environment where liquidity is strategic. And so our focus on deal making is helping companies come to the capital markets. We've obviously had some very strong issuance dynamics and trends in investment grade debt by highest quality issuers. That started last week. We like the follow through that we've seen this week. Smart companies are accessing the market in the US and in Europe. And despite spreads widening, rates have offset that. And we would expect demand to continue for those kind of deals.
Back to the M&A market for just a second before we get to investment grade. You were on a lot of big deals this year, advising Xerox, Credit Karma. There are a lot of deals announced this year that are worth a lot less than they were when they were announced. Do you expect any deals to be falling apart?
I think deals will proceed where they make sense to proceed. I think each one is idiosyncratic and has special needs. If sellers and buyers want to proceed with transactions, those transactions will move forward. In certain cases, both will decide to restructure transactions as appropriate.
So we're also seeing a lot of companies invoke poison pills. That's a decade-long reversal from what we've seen. And what it tells me is that we have activists that are already starting to agitate companies that are beaten already. Are you seeing the same thing here? And are you preparing for another wave of activist activity?
It's a great question. We're very focused on helping our clients prepare for defense in an environment that's complicated like we have right now. Valuations of companies have changed a lot, and we think it's appropriate to help advise them on how to protect themselves. We're in an environment where activism has been Main Street for quite a long time. In these markets, we would expect that to continue. And so we are seeing short-term activities that focus on poison pill in order to make sure that companies protect their interests.
Let's go back a little bit to debt markets. You know, you see a lot of revolvers out there, a lot of bridge commitments as well. What kind of balance sheet do you have available to these firms right now to honor existing commitments as well as make new ones?
Citi is very strong financially right now. We have a great capital position. We have a lot of liquidity. We're very carefully and prudently helping our clients, whether they're corporations, financial institutions, financial sponsors, or governments, with shoring up their liquidity. And so where appropriate, we're offering them new loans to help them, either in industries that are under immediate stress because of the COVID developments, or those who are looking towards longer-term shoring up of their balance sheets, given the uncertainty of economic consequences ahead.
Real quick, Tyler, what is the number one concern you're hearing from clients at this very tumultuous point in time?
Boards, CEOs, founders, government officials are all focused on liquidity. As I said before, it's very strategic right now. And so they're reviewing sources and uses, scenario analysis and stress testing, and making sure that they're in a position to operate their businesses.
So real quick also on the liquidity front, fine, investment grade debt is coming back to the fore, but do you have a time frame for when we can see those riskier parts in the debt market come back to us?
I think as we see the kind of momentum that we've seen over the last several days continue, we think moving down the credit spectrum will be a natural evolution of the market. To crossover credits, we think it's a little bit early to look at the high yield market or leverage loans or equity in size. We think there'll be opportunities there. One of the areas that we're very excited about, in addition to the ones mentioned, is convertible securities.